Most traders believe they are losing money because of strategy. They think the problem is entries, indicators, time frames, signals. So they keep searching. They switch systems. They buy courses. They follow new mentors. But despite all that effort, the results stay the same. Accounts grow slowly, then collapse quickly. The truth is uncomfortable, but simple. Most traders don't fail because of strategy. They fail because of their mind. In fact, one mental mistake destroys more trading accounts than bad analysis ever could. That mistake is emotional decision-making. And until it is understood, controlled, and structured, no strategy will save you. Why strategy is overrated. Trading strategies are easy to find. You can search online and find thousands. Breakouts, pullbacks, support and resistance, indicators, price action systems. Many of them work. Yes, they actually work. The problem is not whether a strategy has an edge. The problem is whether the trader can execute it consistently. Most traders don't lose money because the strategy failed. They lose money because they enter early, exit late, skip rules, increase risk, trade emotionally. A strategy only works when followed exactly. And following rules is not a technical skill. It is a psychological skill. The enemy, the human brain. The human brain was not designed for trading. It was designed for survival. Your brain reacts strongly to fear, uncertainty, loss, and pressure. Markets are full of all four. When money is on the line, the brain looks for certainty, but markets offer none. So the brain creates emotion. Emotion leads to reaction. Reaction leads to mistakes. This is why smart people lose money in markets. Knowledge does not override emotion. Structure does. How emotional trading begins. Emotional trading usually starts small. A single losing trade feels unfair. The trader thinks, that shouldn't have happened. So they rush the next trade. The next trade feels urgent. Rules begin to bend. Risk increases slightly. Confidence turns into tension. Then comes the critical moment. The trader is no longer trading the market. They're trading their emotions. This creates a dangerous cycle. Loss, emotion, bigger risk, bigger loss. Once this cycle starts, logic disappears. Why losses feel personal. Most traders take losses personally. They see a losing trade as a mistake, a failure, a reflection of intelligence. But this mindset is incorrect. Losses are not personal. They are statistical outcomes. Even the best traders in the world lose frequently. The difference is simple. Professionals expect losses. Amateurs fight them. Fighting losses creates stress. Accepting losses creates clarity. Risk, the foundation of mental control. Risk is not just a money concept, it is a psychological one. When risk is too high, fear increases, decision speed increases, discipline decreases. When risk is controlled, emotions calm, thinking slows, rules are followed. Professional traders do not focus on profits. They focus on fixed risk per trade, because risk is the only variable they control. Rules remove emotion. Rules are not restrictions, they are protection. Clear rules eliminate decision fatigue. They answer questions before emotion appears. When to enter, when to exit, how much to risk, when to stop trading. If a rule exists, emotion has no authority. Without rules, emotion takes control. Why motivation does not work. Many traders look for motivation. They watch motivational videos. They repeat affirmations. They try to believe harder. Motivation is temporary. Markets are permanent. You do not need motivation to trade well. You need structure. Structure works even when motivation disappears. Accepting losses as normal. Most traders secretly believe losses are mistakes. They are not. Losses are operating costs, just like rent, electricity, equipment. Once losses are accepted as normal, fear decreases, revenge trading disappears, patience increases. The trader stops fighting the market. They start working with probabilities. Emotional neutrality. Professional traders aim for emotional neutrality, not excitement, not fear, neutral. They do not feel happy after wins. They do not feel angry after losses. Why? Because emotions distort perception. Neutrality keeps judgment clear. Process over outcome. Winning trades feel good, but focusing on winning creates pressure. Professionals focus on execution, discipline, process. Outcomes are random in the short term. Process is controllable every time. Consistency in process produces consistency in results. Why most traders quit. Most traders quit not because trading is impossible. They quit because emotions exhaust them. Losses feel overwhelming. Expectations were unrealistic. Trading is simple, but it is not easy, and simplicity requires discipline. The real goal of a trader. The goal of trading is not to win every trade. The goal is consistency. Consistency in risk, execution, discipline, process. When consistency exists, profits follow naturally. What successful traders do differently? Successful traders trade less, risk less, think slower, accept losses, follow rules. They are not smarter, they are more controlled. The mental mistake that ruins most traders is not lack of knowledge, it is emotional decision-making. The solution is not motivation, the solution is structure. Fixed risk, clear rules, acceptance of losses. Master your emotions and trading becomes simple. Ignore them and no strategy will save you. More videos like this are posted here. Subscribe if this approach makes sense.